Hi, it's Greg Schnell, and I am here with your Daily 5. So here's the S&P 500, and I've got a couple of things I want to point out about it. One of them is that everybody's been talking about the downsloping trend line. I think what's starting to worry me is we've been fighting against this thing for 3 weeks and haven't been able to make progress. And whether or not you think about the black trend line or you think about the 200-day moving average, down in here, we kept kind of getting near it. We tried to finally get over it, and then we failed, tried again, failed. And over here, we've run up against it, pulled back, run up against it, pulled back. And now, just perhaps, now maybe we could finally take off. But the real question I'm starting to ask myself is, we've had 5 out of 7 down days lately, and that isn't very bullish. And then the second thing, and even if some of those days weren't very strong, it basically means we didn't have any upside pressure for sure. So I have this big trend line, and trend lines on the PPO are a really big deal for me. So I have this PPO trend line kind of coming in right away here, suggesting this will be the ceiling for the next rally. And if it breaks out, that might actually signal something new. But I also have this big pocket where we had an uptrend, and now we're barely making this little pocket. And if we were to roll over right away here, that would be concerning. So one of the key reasons that the next few sessions is so important is that all of these moving averages are starting to converge. Now, currently, all three are support because price is above all three. But the other thing would be is if all of these come together and then price doesn't hold above there and we all start to drag down, that would be one of those kind of critical decision point moments for the market, and we couldn't hold it. And by the way, I want to be bullish here. On Wednesday, I got stopped out of a lot of my positions on the gap down on the open. So that was uncomfortable for me because I really do want us to enter into the next bull market, and a lot of my indicators have been flipping that way until all of a sudden we started to get like 5 out of 7 down days. It's really starting to weigh on my indicators. So for me, I continue to watch, and one of the things that is pointing out that is still, and it hasn't changed yet, so it's until it changes, we won't know. But what you see here is when you're in a bull market, the average true range or the size of each move is typically a little smaller. And so during the whole bull market from 2020 to 2021, even though price was actually changing radically and price was even higher, we ended up having a smaller number, anywhere from 20 to 40 points per day was our S&P 500 move. What's really interesting is since the 2022 bear market started, we've been hovering above this 60-point level, and we sit on it, pretty much right on it now. And when we got to this level in August, that's also kind of where we started to bounce. So as you reach the top of the market, we start to have less volatile days. Things are a little smoother. And what I'm finding in here is we're chopping back and forth wildly, and it hasn't really gotten smoother. So I'm wondering if we have the structural strength. Now, that's a big thing for me just to try and figure it out. But what we need to really do here is have not just kind of one stock pushing us up on any given day. We need more thrust. And we just had 2 big days, but essentially over the last 2 days, we couldn't hold it, and we gave all of it back on Wednesday morning. One of the reasons to be very bullish is the sector rotation has been working out really well, and I spoke about it on the Market Buzz show for January 25th, if you wanted to go listen to it. But I discuss how you can see sector rotation and some of the charts that are working. And again, it's what the market tries to do. And if it's unable to do that, then we're probably going to revert back to a different situation. So the charts weren't lined up like this heading into January, but all of a sudden, things dramatically improved. And what we want is on the left side of this chart are the growth sectors, and on the right side of this chart, for the most part, are defensive sectors. So Real estate and banks are typically associated with yield, and then utilities, healthcare, staples, same idea. But these have been underperforming nicely, and the growth sectors have been doing really well. And so as we start the next bull market, we should start to see these sectors lead. Now, the real question is, you can try to lead, and then if the whole market rolls back over, it doesn't work, and you get kicked out. That's where we're stuck right now. Is, as an example, 2 weeks ago the S&P was up. Last week it was down a little. This week it's up a little. And we're just not getting a lot of momentum. Now, a lot of these stocks have made some really nice moves. I don't dispute that at all. I think the real question is, a lot of them you had to buy what was beaten down. And I think the last time I did your Daily 5, I covered off Amazon as a nice setup. Well, it's actually done pretty well from there. So when we're looking at these charts, if we're going to continue this bull market rotation, this is what we should see. Is we should see these strong stocks on the left-hand side of the page, and then we don't really want to be invested in these weaker sectors because we're going to dramatically underperform. Now, one of the surprises for me is I would suggest that if the economy is really going to start improving, I want to see oil and materials do well. Materials has done pretty well, but I want to watch this one really pick up, because crude oil to me is a big economic indicator. So on the first chart, the S&P 500, the three moving averages were coiling together, and they looked like they were trying to support the price as we go higher here. We see pretty much the same picture on the bond market. We also have this same kind of big bubble off the October-November low area where the momentum really picked up, pulled back, and now we're making a more shallow move. And so if this ended up being our high, and we had, I'll call it a lower high on the indicator and a higher high on price, we'd call that negative divergence. So what we'd like is, during a bull market, is that each kind of one of these rallies continues to maintain the momentum. And if you look at the US dollar rally of all of 2022, what we saw was the US dollar continued to keep staying above zero and making good rallies. And then in October, when the US dollar changed, it went below zero and stayed down there for a long time. So we're at this point on the US dollar, on the 10-year. First of all, we've got the 200-day moving average in play. Let's just say it's roughly the same as the S&P 500 moving average situation. And if both of these start to roll over, it would be one of those complex things that it's like the bond market is telling us what we didn't want to hear, and now the stock market rolls over. Of course, we've got the Fed meeting next week. We've got a few more economic data points coming in before that. But we're sitting here with a very tense situation, and this Treasury market is trying to hold the price up at these levels. And if all of a sudden this price starts to fall, that would be a bigger deal. And lastly, I mentioned crude oil. And one of the problems I have, so crude oil basically puts in a big pocket, a little pocket, a big pocket, a little pocket, a big pocket, a little pocket, a big pocket. And now we're starting to make our next one, and it's been almost the same size as the first one, so that's a little bit bullish. But what I'm noticing is we're also starting to roll over here. We've spent about 2 weeks, and crude doesn't really like to spend 2 weeks rolling over. So if we're going to start to experience a lot more weakness, I'd expect it to start to show up pretty much right away. And the concern I have is this November high here, when we started to roll over. The PPO got up around 1 or 1.5. If we're going to roll over right here, this just says we don't have enough momentum. And I think it's important to remember that the stock market also struggled basically sideways through all of November. So we want to keep this one in mind. And with that, if you like the work we do, I'd invite you to head over to Osprey Strategic, check out our stuff. And for those that understand what the strength indexes are all about, we're currently at 52%, which is dicey. I'd like it to be above 75%. And worse is if it goes any lower here, we're definitely below 50% and in negative territory. Lastly, if you'd like to learn more about Osprey Strategic, I'll be putting on a seminar on February 15th at 1 p.m. Eastern. titled Inspiring Hope, Improve Your Paths to Profit. And essentially what we're talking about is the methodologies we use at Osprey Strategic. And it's literally just an information session for you to understand what we do at Osprey and how it might be able to help you keep your profits that you've made, and also figure out when it's better to enter the market. So with that, thank you for taking the time to join us. Good luck and good investing in 2023. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.